Another day, another dollar lost. When will it end? When will the chaos stop? The Nasdaq 100 just fell another 1.2%, pushing it into what we call a mild correction. NVIDIA's down another 3% on the eve of its earnings. More tariffs and export controls are coming for semiconductors, especially NVIDIA, and consumer confidence is in the gutter. So when all the bad news culminates into a single day or week of trading, how do we navigate this uncertainty and how do we trade these volatile times? When exactly does the selling stop and when is the right time to buy this dip? Today, those are the questions we will be answering, along with looking at the big macro picture. The economy is showing clear signs of stress, and the Doge boys just keep on cutting jobs and budgets. So what's next? Are we staring down a bigger crash, a slowing economy, or is this the time to buy the dip? Stick around because I'm breaking it all down. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks fell across the board on Tuesday as President Donald Trump revived tariff threats and the potential for toughening on China, especially with curbs to chip makers, and that weighed on overall market optimism. Now, it mostly weighed on the tech space right here. Tech continues to see pretty solid declines across the board. We saw the mega caps, Microsoft and Google, Meta, Oracle fall, but we also saw some of these smaller software names, everything from CRM, Netflix, Palantir, Intuit, they all fell today. We also saw broad declines here in hardware, with only Apple down 0.02%, again going to show that Apple is the staple of tech simply because of its massively free cash flow generative business model and its huge install base. Now NVIDIA was down 2%, however hardware wasn't as red. We did see a couple of green names. Look at Cisco, GE, Honeywell, and then we actually saw pretty green in the rest of the market. I mean, look at retail trade. Amazon was flat here today, but we had Walmart, Costco, and Home Depot all very, very positive, and this was on the back of Home Depot's earnings. We also saw much of the consumer discretionary space very, very positive, as you can see right here, except for Tesla. Tesla was down 8%. We're going to talk about why a little later on in the video. We also saw energy was down here today, but it was green pretty much everywhere else. So excluding like this part of tech, Tesla, energy, we actually saw some pretty green momentum here in financials, healthcare, consumer services, utilities, commercial services as well, healthcare. So yes, there was a defensive trade going on, but there was also like cyclical and growth components of the market that were very, very positive. For example, look at industrials, right? Up 0.5 percentage point today in the mix with stuff like materials up 0.78%, stuff like healthcare, real estate, and staples. They were all up in excess of 1%. So it really goes to show that we still are seeing a broadly defensive rotation occur under the hood. However, there are some bright spots, like the discretionary space was very, very green today. The only reason why XLY was down 0.51% was because Tesla, the second biggest weight in that index, was down 8%. But I mean, if you equal weight the discretionary space, it was up 1.1% today, and it would be right up here in the top end of the market. Gold was down 1.32%. Very, very weird price action with gold, especially with what we saw with yields and tariffs. And the price action in gold is really telling me that the market is probably looking at a near-term top for gold, and that's why we're seeing the price action we are right now. But then for all of that, guys, we did see highly cyclical sectors really underperform today. Look at technology, energy, and the communication services space that were down 1.3, 1.5, and 1.5% respectively, with the SPY falling 0.5 percentage point. And when you break down the market into its factor components, you saw that growth, particularly large cap growth, took it on the chin. We also saw mid cap and small cap growth not do that well, although they were slightly more positive in large cap growth. But we actually did see pretty solid momentum in large cap value, up 0.42%, as well as small cap blend or small cap core. But small caps as a whole, excluding growth, mid caps as well as large caps were very, very positive. Well, actually pretty positive, relatively speaking, to their growth counterparts. And that again goes to show the rotation under the hood, except for mid-cap value. The market didn't really like that, down 0.31%, but still, there was definitely green in the market, and we certainly are seeing that rotation take place. And it's not just a defensive rotation. We really did see quite a bit of buying underneath the hood, especially in stuff like the discretionary space, commercial services, financials. And that's why some of these like core segments and value segments were actually really positive. That's up 0.42%. The alpha from this relative to this is actually kind of insane. Now let's actually talk about why we actually saw the market decline. Why did this happen? Because it wasn't just momentum that led to this. We did actually get quite a bit of economic data. We got the consumer confidence index from the conference board. We get this once a month. And again, we saw sharp declines in February as more Americans felt uneasy about the future state of the economy. The market expectation for this figure was 102. The actual printed figure was 98. So a huge miss. And this increase likely reflected a mix of factors, including sticky inflation, the recent jump in household goods with stuff like eggs, as well as the expected impact of tariffs. And with this report, we also saw the perceived likelihood of a US recession over the next 12 months increase from somewhat to very likely, as you can see right here. And as a result, that is why we actually saw broad declines in the market. Another reason why we actually saw pretty big declines actually had to do with NVDA, tariffs, and overall export controls. And the Trump administration is seeking to toughen Biden's chip controls over China. The US, Dutch, and Japanese officials met about chip gear maintenance. Now, this is very, very important because the US has some of the biggest chip manufacturers. So too does Netherlands with ASML, and Japan was in the fold as well. The Trump team is eyeing more NVIDIA curb controls, especially to Chinese companies. Now, the US government is looking at curbs on chip sales specifically designed for China. They're going to be reducing computing power that can be exported without a license, and there's going to be more restrictions on the types of chips that can be exported without a license. And that's why NVIDIA today was down in a very big way, leading the tech sector lower. And as a result, when you look globally, China and the semiconductor belt of the market didn't really like this news. They were very red. So too was most of Asia. We actually did see Europe was kind of average. There were red spots, there were green spots, and that was the same for North America. Canada was green, the US was red, South America was pretty green, bouncing off yesterday's move. On the back of the tariff news and chip control news, NVIDIA was down 2.6% today. Now, it is trading at $126 per share. NVIDIA reports earnings tomorrow, guys. That could make or break market momentum, particularly in the tech space. But what people are really going to be looking for in NVIDIA's earnings tomorrow is Blackwell demand. When do shipments start, and when do we see the revenue from that flow on? I think we're going to start to see that in Q3, Q4, and I think Q3 and Q4 in the back half of this year is going to be really, really loaded, and we're going to see NVIDIA probably get back to the 150, 160 mark on the back end, but that's assuming Blackwell demand accelerates in that time period. Now, other market movers, Tesla was down 8% today, very, very crazy. And that's because Tesla reported Europe sales dropping 45% in January. Only 9,900 Tesla EVs were registered in Europe, down from the 18,000 mark a year ago, per the European Automobile Manufacturers Association. Meanwhile, overall EV sales jumped 37% year over year, indicating EV demand was strong, guys, but just not for Tesla models. Now, there could be many reasons for this. Part of the drop may be due to the Model Y refresh. The Model Y is in the middle of a refresh cycle, meaning customers could be waiting for the updated model. There were also new competitive models from Volkswagen, Renault, as well as a number of China aggregators. Now, something else that could be weighing on Tesla stock and Tesla EV sales could be the fact that CEO Elon Musk is seen as meddling in the region's political landscape. People may not like that. And so I think all of these factors led to EV sales being down 45% year over year, and Tesla stock falling 8% today. Not looking good for Tesla. I think this is really going to weigh on demand, but we'll see how this goes as the year progresses. Now, Home Depot guys reported their earnings today. They actually reported a double beat. They beat on earnings, beat on revenue. But the most notable thing from this earnings report was that same-store sales growth turned positive after 8 straight quarters of declines. Revenue grew 14.1% year over year. Earnings grew roughly the same. Adjusted earnings per share came in at $3.13, up from $2.86 a year ago. Great report, and this really did light a fire under the discretionary space. Home Depot was up 3.4% today, and at one point I think up nearly 4.5% at the $400 mark. Now, Bitcoin, a parameter for risk, was down about 4% today, breaking the 90,000 level. As you can see, lower lows, lower highs, and that just had to go with all of the market momentum. And you could definitely tell that today was risk off. We only had 2,800 advances, 3,500 decliners. We saw outflows in both the New York Stock Exchange as well as the Nasdaq in a very tangible way. The S&P 500 down 0.47%, and market momentum is now looking very, very grim across the board. Even the 200-day moving average now below the 50% mark, just under the 50% mark. And we actually did see a slight improvement from yesterday. And we also did here at the 150, the 100, as well as the 50-day. However, broadly not looking good for market momentum as a whole. But like you said, we did see improvements from yesterday to today. And look at the 5-day moving average, look at 20-day moving average. We saw an increase from yesterday, but market momentum as a whole not looking good optically and in aggregate. Now, let's hop on the charts. So guys, very interesting to see broad declines in equities, except for two indices. The RSP, the equal weight, was up 0.1% today, and it was actually positive yesterday as well. So again, that rotation happening under the hood, the market is definitely preferring to keep its capital in the broad market, but in large caps over stuff like mid caps and small caps. However, the S&P 600 was up 0.1%. This is profitable small caps. However, the IWM was down 0.38%. The S&P 500 down half a percentage point like yesterday, and the Nasdaq 100 down 1.24%. Another pretty brutal day for the Nasdaq 100. However, we are seeing pretty bullish price action in extended hours. As you can see, the IWM, RSP, and the Qs all seeing a bit of a bid come into the market after hours. That might be because of some of the earnings names, and we may look at them a little later. Now, value was up ever so slightly, completely outperforming growth as a whole. We did see volatility tick up 2%, but what really moved the market today was yields. Yields fell 1.85%, 2.36% in the 10-year yield and the 30-year yield. We also saw the dollar decline as well. Now, why did this happen amidst tariff concerns? It actually had to do with a note that was circulating Twitter and the markets, and it was talking about how Elon Musk, Trump, and Scott Bessent are looking at the yields market and how they actually want to lower yields as a whole. Here is the note. This was circulating Twitter and just the finance community. Now, it said, Musk got the message loud and clear. The bond market was downing him, demanding more evidence that the cuts were adding up fast enough to actually rein in the bloated budget deficit and curb in ever-growing national debt. They're talking about Doge here. This, Musk insisted, was a mistake they'd come to regret. The bond markets do not currently reflect the savings that I'm confident we can achieve, he said during a freewheeling hour-long discussion he led on his social media platform X. If you're shorting bonds, I think you're in the wrong side of the bet. Trump has famously obsessed with the market as a real-time referendum on his presidency, but now with Musk and Treasury Secretary Scott Bessent in his ear at the start of his second term, much of the attention has shifted to another benchmark, the 10-year Treasury bond yield. And I think Musk and Trump have realized that, hey, if we really want to support the market, instead of obsessing over the stock market, right, we need to look at the 10-year Treasury. And if we can actually get that lower, everything else will come as a result. And I think that is what we're starting to see. If the Doge boys can be very, very successful in reining in spending, looking at the second year, third year of Trump's presidency, we could see yields move lower, and that could really put a bid under bonds. And that will support not just the stock market, but the economy as a whole. And we're starting to see that trade take place with the dollar falling as well. And I think that's part of the reason why we saw stuff like the S&P 600 up today in a red market, as well as the RSP. But we'll see how this plays out too. There's a lot of moving parts to this boat, guys, and we'll take it one day at a time. As a result, bonds, the AGG, the TLT were up today, but looking a bit sour in the pre-market in the extended hours. Bitcoin was down 3%, recouping a little bit of losses off the lows, powering a little bit of lows. And then we see gold was actually flat today, but that is not actually the case. That's because the after hours market just opened. Gold was actually down 1.29%. However, if we actually look at this wick, you could see quite a lot of buyers did come in. So gold buyers did step in on the back of the tariff news that we saw today. Silver was down 1.85%, WTI fell, natural gas was up. But let's actually talk about the S&P 500, down 0.5 percentage point today. And in yesterday's video, I said we want to wait for a close below the gamma flip. If that happens, we want to target the 5,900 area. So for those of you that don't know, this level right here is the gamma flip zone. Above this level, we're kind of bullish, aiming for this level right here. Below this level, we are bearish, aiming for this level right here. This all has to do with the options market and how option dealers hedge their portfolios. In negative gamma, dealers sell into weakness, buy into strength. It's why you get quite a lot of volatility. Whereas in positive gamma, dealers buy dips, sell rips. That's where you get this like very steady price action. And that's exactly what we saw today. So we broke the gamma flip, we've closed below, and our target now is 5,900. However, we may have already hit that target, as you can see right there. We did actually open the day slightly in negative gamma and we came all the way down. However, dip buyers took the opportunity to buy the dip at these levels, and that was what's kind of crazy about today. Let's say we close like here, we could actually look for movement to the 5,900 area, but we may have already got that in a single day where we break negative gamma, come down and have dip buyers buy the dip, and that's exactly what we saw. So I'm actually constructively bullish from here. Now, don't get me wrong, we are in negative gamma, and that means our target is still 5,900. However, we may have already reached that target. We can definitely see lower levels, and if we do get here, you need to buy the dip very, very quickly because things can turn for the most part. And we may have already got that level and got that momentum trade lower already. So guys, what you want to look for now is we go ahead and continue the price action to the upside and close in positive gamma. You want to target the 6105 level. But in the here and now, because we closed in negative gamma, 5,900 is still our target. But do be aware, we may have already gone and reached that target right there. Nonetheless, you do want to be selling to weakness and buying into strength here in the negative gamma. And our target is 5,900. Unless we go ahead, break the gamma flip, then our target would be the 6105 area. But I think you actually want to buy this 5,900 area. Why? Because it's an equal low relative to these lows and a high low relative to this low right here. Also, when you actually look at it from a peak to trough basis, right to there, we're down about 4% in the S&P 500. But when you actually look at the Nasdaq 100, very similar situation to the S&P 500. Yes, we did close in negative gamma. Ultimately, our target is the 20,900 area, but we may have already hit that target. And from here, based on the dip buys that did come in this week right here, we may actually see more upside momentum now than downside momentum, especially because, again, if we look at a peak to trough drawdown from where we are, right, we're looking at 5.86% drawdown. Generally speaking, 5% dips have been bought across this market in the last couple of years, especially when you see yields moving down as they did. This is very, very bullish, and I think we're going to see much of the same looking ahead for the rest of the year. But for the Nasdaq 100, guys, ultimately we are in negative gamma. That means 20,900, or the put support, is our target for both the S&P 500, the Nasdaq 100. But we've approached these levels very, very closely already, and so we could actually see more upside from here, and that is my recommendation. I think we're probably going to see a move and retake the gamma flip zone over the next couple of days into the weekend. So we could see a move up here, and then either going to be resistance and take us lower, or we're going to break above, use it as support, and then make the next move to the upside. It's all going to be dependent on technicals tomorrow, what the market looks like, and I think NVDA's earnings. NVIDIA's earnings is really going to move the Nasdaq 100, but I'm actually getting incrementally more bullish from here, and I think risk is to the upside from where we are right now than it is to the downside. However, you do want to be aware of this low right here in the Nasdaq 100, as well as the same position in the S&P 500. That would be this low right here. Okay, if we go ahead and actually make a lower low below this, all bets are off, and then things are going to look really, really grim. But I would be a big buyer of dips right here, looking for upside momentum for us to go ahead and break the gamma flip, looking for higher price action, potentially all-time highs as we enter into the March OPEX period, as we go into March, which is slightly more bullish when it comes to seasonals. And looking for the next 3 to 4 months, we are in a very seasonal bullish period especially as it pertains to a US presidential election year. Looking at the RTY for the most part, guys, RTY, very similar situation. We're at the bottom end here in negative gamma. I'd actually be a dip buyer. I'd be a dip buyer looking for us to retake the gamma flip and for us to go ahead and hit that core resistance. So I'm actually incrementally more bullish. I know it's a bit of a contrarian take. We could definitely go lower and I could be wrong. And if I am wrong, you'll hear it first. But I think this is an opportunity to buy the dip. I do think we go higher in the Nasdaq 100, the S&P 500. But this is going to be the absolute key right now. It's going to be this core resistance. We could actually make a move up here. And if we find resistance at this level, probably means we do go lower. However, if we break above and move higher, we're definitely going to go higher. But I am incrementally more bullish for us to go ahead and target the gamma flip zones for both the Nasdaq 100 and the S&P 500. I think either tomorrow or the day after tomorrow, we'll go ahead and hit the gamma flip and then make our next move from there. So that is what I recommend. That is what I think will happen. But guys, everything else looking pretty good in the market. The RSP showing a lot of relative strength, forming a very, very solid base right here. I think we move onward and upward. That's the key level to break. The second we do that, we're going to go ahead, break all-time highs. Extreme relative strength. Look, the RSP up 0.8% yesterday and up 0.1% today. Very, very solid market momentum in the context of the Nasdaq falling about 1% over the last 3 days. Very, very solid alpha in the RSP for the most part, and also profitable small caps. There was definitely some dip buying going on under the hood as it pertains to the markets of the whole. So guys, I'm constructively bullish. I think we're actually going to go ahead and hit the gamma flip. I think we could definitely retest the 5,900 here, but I think we're going to see the 5,980 level on the back of NVIDIA's earnings tomorrow. And let's talk about S&P 500 and the returns we've seen so far this year. So the S&P 500 has returned 2.2% returns. We've seen 1% in EPS growth and 1.2% here in multiple expansion. So we're seeing roughly half and half returns from EPS and multiple expansion. It's what you would expect from total return drivers. But have a look at financials, guys, up 4.8% for the year. That's because of a 4.6% drive in EPS growth, only a 0.2% move in multiple expansion. Materials seeing actually negative earnings, but a massive move here on PE growth. So look at technology, down 0.3% for the year. And we've seen 1% increase in EPS, negative 1.3% in multiple expansion. So as a result, we are seeing technology become a little bit cheaper in retrospect. However, that sector as a whole, very expensive. Nonetheless, we are seeing half and half returns from the market from earnings and multiple expansion. It's definitely something you'd expect in a market like this. Now, looking at sentiment as a whole, this is CNN's Fear and Greed Index, and we are in the fear. And yesterday, we actually did get into the extreme fear zone ever so slightly. We have pulled back a little bit, but we are still here in this extreme fear zone, which you would consider to be a buy zone nonetheless. And I still think that equities are a buy and will be a buy for most of this year, especially if we do get a material pullback. Why? Because we are seeing exceptional earnings growth. In fact, if you actually have a look at S&P 500 blended earnings, we're looking at 17.6% and very close to 24% if you exclude the energy sector right here. Now, this is Fundstrat's earnings expectations. This is what they see. Mine are not quite as positive in terms of earnings, but nonetheless, we're still looking at very, very robust earnings growth and just absolute growth relative to 2024. However, we have seen a bit of downward revisions lately here in 2025, but to be expected, and earnings revisions have been typically above what we normally see or the average here. And guys, the volatility we've been getting here in the month of February, when we actually look at seasonality for a presidential election cycle, the first year, normally February, we see negative 1.66%. Only 45% of the time we're higher. And this type of volatility does actually tend to extend here in March. We see slightly positive returns, but only 50% of time we actually move higher. And that's why in this February-March period, we actually want to buy the dip, because what we do see is that April, May, June, and July tend to be very positive years in the first year of a presidential election cycle. And we want to buy the dips, riding the coattails of what's to come here in the middle of the year. We do get quite a bit of volatility in the back end as well, but then we see November and December very positive. Nonetheless, guys, take opportunities like these to buy the dip, especially when you have earnings like this. And the type of volatility we're seeing, this indecisiveness, what we're witnessing, tends to resolve pretty quickly, and typically more robust returns follow, especially when you have earnings where they are right now. This is what we're currently doing. This is the average path of the 10 closest matches. And what we can expect is just continued sideways momentum and then a decisive break to the upside, and we'll go from there. So guys, be patient, sit through the volatility. It's going to be a very bumpy ride, but there are plenty of tailwinds. And one of them is simply the fact that the Treasury will inject roughly $800 billion from its TGA account into the private markets over the next month or so, simply because the Treasury can't issue any more debt. The Treasury have hit their debt ceiling, and now it's up to Congress to either extend the debt ceiling or put it on pause. Nonetheless, the TGA is going to be drawn down, and this is just a massive liquidity injection into the market. It goes from the Treasury general account into banks, and they hold that liquidity, and it could be distributed across the entire market. Now, looking at the macro, there's some more concerning things, and we'll be talking about the concerning things we've seen in the macro. This is Goldman Sachs GDP tracking estimate. They've actually moved it down now to 1.9% after some of the data we actually got last week. So now we are actually below this 2% mark, and that is not good. If this becomes the consensus, guys, things can get really hairy in the equity markets. However, when we look at the overall labor market, at least what we're seeing right now with federal employment tax receipts gaining 3.4% year over year, so far in the month of February. February's not done, however, and actually seeing 15% growth here in the month of January really goes to show that the labor market is still hanging in there for now. However, there is a little bit of concerns when it comes to the labor market. If you actually look at macro edges, jobs cut tracker, what they've actually seen is plenty of jobs have been cut as the Doge team goes ahead and continues to lay off federal employees. Now, this is a long-term good thing, especially if the private, more productive market can absorb those jobs and we pretty much move jobs from low productivity jobs to high productivity jobs. That would be better. However, in the short term, it can create volatility. Now, looking at earnings and data for tomorrow, guys, the big one is NVDA and Snowflake, but mostly NVIDIA. They're reporting after the close, and all eyes will be on NVIDIA. But we do have a couple of other big names. Salesforce, Marathon Digital is reporting after the close as well. Snowflake 2, C3 AI, Advanced Auto Parts, Energy, Lowe's is also reporting, Stellantis. Those are some of the big names, but all eyes will be on NVIDIA. This is what everybody is going to be watching. And then looking at data tomorrow, the two big ones is going to be here. New home sales year over year, month over month. Now the forecast is for 0.68 million or 680,000 and a negative 2.6% month over month decrease. That's about it. We also have Bostic and Barkin speaking. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.